guys, I'm Jamie Troll. I am a CPA, a financial literacy coach, and a profit strategist. And more recently, I have spent most of my time over the last couple of months now just researching and really trying to understand all things stimulus so that I can help you guys understand it and know how to get access to some of these funds to help your business. I did a video not too long ago on what can I use an EIDL loan for, and it was really popular. So I wanted to do a second video on the EIDL because I know a lot of you guys at this point are getting those invites into the portal. You're seeing your loan offer, hopefully, and you're trying to decide, okay, what do I do? Maybe you're reading through the paperwork and trying to figure out if it makes sense for you to accept the EIDL and really think about the plan you're going to have for the payback on that as well and whether it's worth it. So I wanted to talk through a few things from that I think are really important to consider when you're deciding, should I take it? Or maybe you've already taken it, but you're trying to decide how you should spend it, what your payback period should be. And I've also got a free tool. So if you stick to the end, I'll tell you about the free tool that you can download that will help you with all of this. Okay. So first, though, I want to point you guys to my other video. If you haven't seen it, I'll link it at the end here. So once you're done with this video, go watch that one over there. It's called What Can I Use EIDL For? And we dive into the contract. We dive into some other information that's come out from the SBA that specifically clarifies what you can use with it and what you can't. And there are a decent amount of restrictions you need to be aware of here, okay? So today we're going to talk, though, about a few things you need to consider if you're really thinking about getting this loan or trying to figure out what to do with it. So one thing I definitely want you to consider is the collateral impact. So if you get a loan for more than $25,000, you essentially are agreeing to put up collateral for that loan. It's a business collateral, right? But that could be fixed assets that you have, that could be inventory, different things like that that you carry as assets for your business would be considered collateral for that loan. They could come take that collateral if you do not pay that loan. So for a lot of people, the fact that there's collateral at that level of $25,000 may make you think about, okay, maybe I will reduce the amount that I take of the loan, which you have the ability to do. So if they offer you $30,000, maybe you want to take that down to $25,000 or $20,000 to make sure you get out of those collateral requirements if that's something that you are worried about, okay? Now I'm going to show you the contract really quick just on the collateral piece because I think this is important. But basically you can see here that the borrower will not sell or transfer any collateral except normal inventory, of course, because otherwise that wouldn't make a lot of sense, described in the collateral paragraph hereof without the prior written consent of SBA. So you're going to have to ask the SBA if you want to sell any of your equipment, if you want to dispose of any of your equipment, you're going to have to go to the SBA and ask because technically they have claim to that equipment. So that's something to consider for sure, okay, is the implications around carrying collateral for your business. So the other thing that I want to make you guys aware of is the fact that you are limited on your distribution of assets, okay? So what does that mean? That means that the borrower will not, without the prior written consent of SBA, you'll kind of see that a lot here, right? That prior written consent that you're going to have to basically ask the SBA, hey, can I do this? And then they have to tell you yes. Without that prior written consent, make any distributions of assets, give any preferential treatment, make any advance by way of loan, gift, bonus, or otherwise to any owner or partner or any of its employees or to any company directly or indirectly controlled or affiliated with or controlled by the borrower or any other company. You're probably like, what in the world does that say? What that seems to be saying, and importantly, I am hashtag not a lawyer, okay? But what that seems to be saying to me is that if you're a corp, for example, this wouldn't really apply in the case of sole proprietors and LLCs because of the way that you pay yourself. It's not quite the same. But if you pay yourself via payroll, if you are a corp, you should be paying yourself via payroll. You can take those salaries, but technically, according to this, you would not be able to distribute owner's draw, for example, during the time that you have the loan. And for a lot of corps, that could be a huge deal breaker on this, right? A lot of you guys maybe take quite a bit of your earnings in the form of owner's draw. And I think that the way the SBA sees this is, hey, if you've got enough money to distribute your earnings, which it's really considered kind of more akin to investment earnings than it is payroll because you don't pay payroll taxes on that part. then they're saying, well, maybe you should pay back that loan instead. So that is something to definitely keep in mind when you are thinking about taking the EIDL loan. Think about what that's going to mean for how you pay yourself and whether you're going to have to change anything with the way that you pay yourself. Now, remember, this is an emergency loan, you guys. And so I think a lot of people are thinking about this as a cheap source of capital, and it is fairly cheap as far as business loans go. At 3.75% interest over 30 years, that's fairly cheap. But you can't use it to buy fixed assets, okay? You can't use it to expand your business. Those are things that are very specifically called out that you can't use it for. It's working capital. What is working capital? Well, that's normal use in your business, normal cash usages in your business, but not investing activities, not financing activities. Financing would be paying off long-term debt. Investing activities would be growing your business, buying fixed assets. Those are things you can't use this for. So that's important to keep in mind when you're deciding, do you want to get this loan or not? Okay, so I promised you guys a freebie. Go check out above, balancecfo.com/EIDL tracker. It is a tracker and a calculator that is going to help you understand the implications of EIDL. It's going to help you be able to see exactly how the interest works for EIDL, how it's being calculated out, how much you're going to have to pay over that time period. And it's also going to be a place where you can track your spending for EIDL. Because remember, there are some things you can't use this on, and it's best to keep record of everything that you're using EIDL for. So let me jump into this tracker quickly, and I can show you kind of how it works. Okay, so now we've jumped into the EIDL tracker, which is also a calculator that's going to help you really understand the implications of your EIDL on your pocketbook and the interest component specifically. All right, so let's jump in here. There's only a few pieces of information we need to put in, and then it's going to tell us a lot. So let's put in that we got the loan. Maybe we got it on the 1st of June, and the loan amount was for $100,000. Okay, now it's going to shoot out here and say your monthly payment is $489 down here. It's gonna calculate that out based on the numbers that you put in. Oftentimes that's gonna be exactly right. In some cases though, the way your payments are rounded might be slightly different. So check your paperwork and see, and you can override it if you need to. So let's say 489 wasn't exactly right, and really on the paperwork it said 490. You can override that and make it 490. Okay. So then once you put in just these couple of pieces of information, you can come down here to this loan summary tab, and it's gonna tell you a lot, okay? It's going to tell you your monthly payments, which we already know. It's going to tell you the interest that's accrued during the 12-month deferral period. So remember, we don't have to pay for 12 months. We're not going to have to make a payment on this loan for 12 months from the date that we got it. But interest is still accruing, okay? And the way that interest works, it's just like a mortgage, that in the beginning, because you have the most principal outstanding, because you have a lot of principal that it's calculating interest on, your interest is going to be higher towards the beginning of your loan than it will towards the end, okay? So you're going to see kind of a front end weighting of that interest just based on how typical interest amortization works. So this is what you're going to see. So you basically would have $3,750 worth of interest that will accrue during that first year before you've even made a first payment on this loan. Okay, now that interest will be spread over time. You don't have to pay that all a year from now. It'll be spread into your payments. It's already considered in your monthly payment amounts. But know that you are accruing interest. I think that's something really important to keep a finger on, because some people are taking this loan as an insurance policy. They're not really sure if they're going to need it. They might want to hang on to it for 6 months, maybe a year, see what happens with all of this COVID stuff, and then decide whether they're going to pay it all back or not. Okay, and if that's you, that's fine, but know what that means for you from an interest perspective and make sure that that makes sense when you compare the risk versus reward of it. And that's going to be a different decision for each business owner and where you currently stand in your financials, okay? Okay, then you're going to look and see, okay, if I kept it the whole 30 years, right, which goes through 2050, you guys, I hope that strikes some of you as just crazy, because I really don't think these loans, while they are 30-year terms, they're not meant to be paid over 30 years, okay? These are emergency loans that hopefully when you have the cash flow to be able to pay them back, you can get rid of them. And remember the things that we talked about previously, right? Where they can take collateral. You might have to actually tell them if you decided to move your business, right? You have to get written permission for things as long as you have this EIDL loan outstanding. So you want to make a plan to get this thing paid off as quickly as you can. Okay, I really fully believe that, because yes, you have interest that's accruing, and you've also got a situation where the SBA has say into your business, right? There are things that you're going to have to do. There are records you're going to have to keep. There's things you're going to have to show them over time. And especially if you get over $25,000 and have collateral, right? Now you're going to have to get permission to sell assets and things like that. So this is not a loan that you really want to have out for a long period of time. This is not a typical type of SBA loan to help you build your business. This is to get you back on your feet and get through this emergency. And then you should make a plan to get this paid back quickly. Okay, so that's what I would say to anybody who has decided to take the loan and they need that extra backstop. It is better than racking up credit card debt. Okay, it is definitely a better solution than that, but it is debt, and debt is debt. So let's look down here again. Payoff date is 2050 for 30 years. So you're going to pay $70,000 in interest. Essentially, every dollar you borrow turns into almost $1.50. That's how you need to look at it. Is that's what you're doing. You're gonna have to pay back almost $1.50 on every dollar that you borrow. Okay, so what if you look at this and you say, oh my goodness, I did not realize how much I was gonna have to pay back in interest. I didn't realize I don't want this thing outstanding for 30 years. How can I make a plan to pay it back faster? Let's do that. So there's a couple different options I've put into this spreadsheet that you can play around with and decide what makes the most sense. But a lot of people maybe took the loan because they took the max amount, and then they realized, shoot, I don't want all of this. I don't want all this interest accruing. I might want to keep a little bit, but not the whole thing. So maybe you got this $100,000 loan and you said, oh my gosh, I'm gonna go ahead and return half of it before I even start spending the thing. I'm just gonna hand it back, and you can pay it at pay.gov. That's where you would go to pay off a portion of your loan or the whole thing. You'd go to pay.gov. So you put in the $50,000, okay? Then we're gonna see what happens. If that's all you did, if you just kind of immediately within the first month of receiving it, pay down $50,000, essentially what you're gonna see is that first period, you're gonna save $1,700 just in that first 12 months by paying back that amount. Over time, now all of a sudden your interest paid is only $13,000, you guys. That's way less. It's half the money, but it's less than half of the interest payments, okay? So the amount you're gonna save on those early payments is $56,639 by just cutting that amount in half, okay? So it's also gonna change your payoff date. Now we're not talking about 2050 anymore, right? Which was just nutty. Now we're talking about 2032. Still far away, but, in a reasonable sense. I'm hoping by 2050, I'm hanging out on the Italian Riviera. I'm not worrying about my EIDL loan, right? 2032, okay. Life is probably still somewhat similar to what it is today. So that means we would pay it off within 12 years, all right? Now, what if you say, you know what? I don't even want this thing for 12 years, right? I still would like to give some back. Maybe you wait and you say, okay, I'm going to hold on to half of this for 6 months, and I'm going to see what happens. Then decide if I'm going to pay the whole thing back or if I'm going to pay a portion back. And let's say 6 months down the road, you still have, used a little bit of it, but you still have quite a bit left over, and you realize, you know what, I'm not really going to need this. So I'm going to pay back another 25 right now. It's going to completely change your numbers. Once again, now you can pay the thing off in 6 years if you did that. Okay. So you can kind of play around with what your early payments look like and see what that means for you for interest and for the length of the loan. Additionally, what you could decide to do is, you know what, I'm actually going to keep the whole $100,000. I'm going to keep it, but I'm just going to pay it down way quicker. Like instead of paying $490 when those payments come due next year, every single month I'm going to pay an extra $200 to it. So I'm going to pay $690 and essentially save 30 grand and 12 years off of this thing. Okay. So it is so important that you make a plan to pay this thing off. You do not want, in my opinion, as a CPA, I would not want to have that beholdenness from the SBA. I would want my business to be my business and I make the decisions in my business, right? So the quicker you can get out of this thing, the better. And the less interest you can pay on this thing, the better in most cases, right? Because you can't use it to grow your business. It's not an investment in your business in the same way as other loans may be. So I would try to get it paid off as quickly as you can. So I want you guys to make a plan. And I don't want you to make a plan in a year or 2 years or 5 years. I want you to make a plan now and use this to make a plan to say, okay, here's how I'm going to get this thing paid off in the amount of time I want to have it paid off. All right? And then commit to it. And make those extra payments and just make sure that you are keeping up with that, because that will help you. That diligence around paying back that debt helps to make sure that your dream doesn't become a nightmare, okay? That you aren't saddled with this debt for years and years and years to come and still trying to get out from under it, right? We want to make a plan immediately. We want to use this for the intention it is meant to be, which is to get through this emergency, and then we want to pay the thing back. Additionally, you can use this same workbook to do a spending log, okay? So this is really going to be a spending log for you to be able to write down the things that you've spent EIDL money on, okay? And this is great to have in your back pocket if you are ever asked. This is not the same as the PPP where you have to kind of show this schedule to get forgiven. There's no forgiveness here that we're talking about with this EIDL loan, okay? But we do need to write down and keep good records in case we're ever asked to provide them and show what this money has gone towards. It also helps us to keep good diligence around the money. So I do recommend putting it in a separate account. That keeps you from having it get commingled with all your other business funds, and then you end up maybe not using it quite as judiciously as you would if you put it into a separate account and just pulled as you needed it. That's really the best way to use it, in my opinion. I think you're going to make better decisions when you do that versus just kind of putting it all together into one account. And then you will also keep track of it by saying, okay, here are the things that I spent EIDL money on, okay? So this is a great tracker. It's going to be able to tell you how much you've spent, how much you have remaining. It's going to make sure that you actually write in, yes, I have kept the support. Maybe you write a location of where that support is if you want to here. What bank account it came out of. If you have multiple bank accounts, that's useful. So you could just put the last 4 digits of your Bank of America account or something like that. And it will help you just keep those good records. You do need to keep receipts for 3 years at least, according to the loan documents. You need to keep good books and records, including a P&L, things like that for a full 5 years. So make sure that you have this information readily available. This is going to be a great place to actually be able to document where all your EIDL money has gone, okay? Okay, so that's really all I had for you today. Again, go and watch my other video, which is showing on the screen here in a minute. And also make sure that you join my group. So I have Financial Literacy for Women Business Owners. It is my group. I am answering all of your questions on stimulus-related things over there. So if you have more questions or want to see more content, go over there. Also, make sure to like this video and subscribe if you liked it. And I really appreciate you guys being here. Have a great rest of your week. Bye-bye.